Hello, good morning, good afternoon, good evening. Thank you all for joining the R3 Future Forum. Here in this forum, we discuss the most pressing topics on the on-chain capital markets. We started this group around 3 years ago to tackle the most difficult questions and move the industry forward collectively. Today is the first live session that we've opened up via various streams, so X and LinkedIn, etc. So you are able to participate. If you want to add comments, questions to the awesome speakers, please put them in the comment section. So today's topic, we're looking at asset management on chain. Funds on chain, they are scaling. There is an emerging asset management industry on chain, new product packaging, new distribution rails. But the question we've had as an industry in TradFi is, what does this look like when asset management comes on chain? And so across the speakers that we have today, we have a good coverage across the value chain, from custody to asset management, sub-advisory, fund administration. So it's a great look at great panel of speakers. Hi, Jeff. So great panel of speakers, which we will get into some of the details, and feel free to throw in some questions. So without further ado, I'll hand over to the speakers to introduce themselves and their firm, what they're doing. So Angie, we'll start with you.
Okay, hi everybody. Thank you very much for inviting me, Marcus. It's great to be here. My name's Angie Waqar. I run commercialization for Apex Digital, based out of London, and I've been in the blockchain DLT space alongside Marcus and Mark and various other people for many years, about 9 years now. So it's been a fantastic journey to date. Just for those who don't know us, Apex is basically a fund administration transfer agency, corporate services organization globally. So we look after about 10,000 customers, around 3.6 trillion of assets under administration that we look after all over the world today. So Apex Digital was launched about 3 years ago and is now probably the fastest growing part of our business, and is all about how we deliver digital infrastructure and digital technology to both our existing client base and the new client base of customers that are starting to drive their digital innovation journey within the asset and wealth management space. So it's great to be with you and delighted to be on such a fantastic panel with my colleagues. I'll hand over to Mark.
Thanks, Angie. Appreciate that. Hi, everyone. My name is Mark Garabedian. I head up digital assets and tokenization for Wellington Management. Wellington has about 1.3 trillion in assets under management. Our strategies span the entire investment landscape: public equities, private equity, public fixed income, private credit, alternative strategies. We service clients globally. We do a lot of sub-advisory business, and that's largely the business that we've entered into for the tokenization realm. My background is in trading. I've traded literally everything, everywhere.
Can you all hear me? Because I seem to have lost sound just out of the blue.
Yeah,
I can't. I can't hear anybody. Could hear all the introductions, and then wow.
Keep going, Mark, and we'll,
now I hear you. Now I hear you.
Okay.
I missed Angie's introduction. I don't know what happened there.
Okay. All right.
But that's okay.
Going,
Were
Mark.
You calling on me? I'm sorry. I don't know who.
No. Sorry, no. Mark's still going.
Okay.
So I was just saying, I've traded everything, every which way, all across the globe. I did that for 2 decades. And built an expertise in market structure and market microstructure. And so that's the lens I come into this space with. The first time I traded on chain, directly on chain, I recognized that this is the future of the asset management industry, and sort of dove headfirst in. So my remit, I focus on tokenization, finding opportunities for us to put strategies in token form with peers and partners, as well as using blockchains for our business operations, and looking at touching digital assets directly for investments. Pleased to be here. I'll turn it over to you now, Lewis.
Lewis, can you hear us?
I think we might have lost them.
Waqar, do you want to go?
All right.
Just before you go, can I say, when we switched over to the other speakers, I lost sound. So I couldn't hear either of the other 2 speakers. So I don't know if that's going to, I just jumped in just to say that. So maybe someone on the technical side could look into that. So I couldn't hear the other prior 2 speakers. I can hear you now, but the moment you hand it off to the next speaker, then I lost the sound on my end.
Okay. We can hear you. Go for this.
Shall I do my intro? Sorry, I didn't mean to interrupt. Well, anyway, so we'll do a little blend. It's live TV. That's how it goes. It's a pleasure to be here. My name is Cohen. I'm the co-head of the Cahill Next practice at Cahill, Gordon, and Reindel, which is a 100-plus-year-old Wall Street firm. What's a crypto practice doing in a Wall Street firm, you might ask? It's the very heart of what we're talking about here. It's bridging traditional finance and decentralized finance together. We do a lot of work around tokenization, including around funds, and I'm thrilled to bring a kind of legal regulatory mindset to this discussion.
Thanks, Louis. All right, I'll go next. Hi, everyone. Really good to be here. I'm the Global Head of Digital Assets for Financing and Security Services at Standard Chartered Bank. We are a 170-year-old bank with presence in over 41 countries around the world, and we manage quite a few trillions. I can't even recount how much we do at the moment across the various entities, but within my business area I'm in, we're just over 2 trillion in AUM at the moment and growing quite rapidly. We are a frontier bank that has set its sights on digital assets as a core pillar of our strategy, as well as making sure that our cross-product capability across transfer agency, fund admin, custody, banking services, as well as tokenization and crypto services, all are unified and under a single umbrella. Look forward to the conversation for the rest of the hour.
Brilliant, thank you all. So the topic we want to get into is asset management on chain, and across you all, you cover a great perspective from the value chain and how TradFi comes onto DeFi rails. The first question we want to touch on is the demand. So a lot of our audience are TradFi participants who are looking at how they bring assets on chain, what they do, and a lot of that is demand centric, so customer-driven strategies. And where are you seeing the demand from? Is this new clients going into crypto? Is this clients looking at bringing their existing assets on chain, new services? So in terms of the demand that you're seeing, maybe start with you, Mark, because I know you've publicly spoken about Wellington strategy being customer centric. So yeah, we'll start to you, and then please jump in other speakers.
Yeah, so the way I describe this to people is really today there's two pockets of capital. There's the pocket of capital that exists on chain, and then there's all of the rest of the world. And so largely, our strategy today is servicing the pocket of capital that exists on chain, the people who are digitally native, who hold their assets on chain, want to keep their assets on chain, and are looking for robust investment opportunities that exist on chain. For servicing that community, much of the demand as it exists today has really centered around fixed income strategies. One of the bigger benefits around tokenization is the utility of the underlying assets. Once you tokenize them, they becomes all sorts of extra added benefits that you get, including the ability to collateralize pretty seamlessly and easily, which allows for carry trades and levered carry trades. And so that's largely where the demand exists on chain. It's differentiated from the wave that occurred back in 2021. Back in 2021, you saw a mass inflow of capital on chain, but the underlying strategies were not based on the real world assets and tokenized funds that we have today, but they were based on crypto assets and other investments that while they provided yield, the yield was not sustainable. So now today you've got sustainable forms of yield that exist on chain. You've got more coming, and you've got on chain investors that are looking to access those. And like I said, utilize carry trade strategies and levered carry trade strategies. However, at the same time, we are constantly going out to the off-chain community and showcasing the abilities of having their assets on chain. Again, the instant settlement, the collateralization. Probably the thing that doesn't get talked about enough is the enhanced transparency and the efficiencies around record keeping and reconciliation that occurs when assets move on chain. People will do it in drips and drabs and slow motion and pilot phases, and we're here to help. We want to make sure that we stay innovative, showing our clients the benefits of new technology and what this can bring to the space, and being there as a trusted partner as they start their evolution on chain.
Angie, do you want to go next?
Yeah, sure. So probably following on from the theme that Mark started with, actually, but just to step back for a second, if I just sort of frame the context with which we're coming at it from an Apex Digital perspective, because I'm seeing quite a wide spectrum of interactions around people that want to start their digital journey in the wealth space and the asset management space. So I mean, if you think about where we come from, we've got this large community of people who are basically issuing private market funds, and that could be real estate, it could be infrastructure, it could be private credit, it could be hedge fund, it could be, so there's a sort of fairly diverse range of fund types that we're supporting today. But what we're seeing, and if I just go into the sort of funds and the assets first, and then I want to touch a little bit on where we're going on the digital currency side, and Mark alluded to that with things like settlement on chain. But on the asset side and on the fund side, we're definitely seeing both in our existing client base within Apex, but also in new customers coming in to have that conversation because they want to start the journey. We're seeing quite a large number of clients, and particularly in the last 9 months, I suspect everybody else has seen that massive uptick in the last 6 to 9 months. We're seeing a large increase in the number of clients who want to either tokenize a whole fund, or they want to tokenize a share class within an existing fund. Now, typically, if it's a share class within an existing fund, it's possibly because what they're trying to do is expand the rails of distribution to a wider investor community, and that would be a really obvious place for doing that. And a good example of that is the work we did recently with Skybridge. We put about 350 million onto a blockchain just in order to broaden the rails of distribution for that particular issuer. So that's one option. Or they want to tokenize the whole fund, and they could be doing that because they want to drive the management of the ownership on chain. Or what we're seeing more of at the moment is where people are dividing the life cycle of an asset, particularly in real estate. This is really popular, where they take the life cycle of the asset. If you think of some of these really big giga projects, we're doing things like, laying gas pipes for thousands of kilometers, and then managing the long-term strategy around the deployment of that infrastructure and the deployment of the assets to the end consumers over time. Then these are really, really good examples of where through smart contracts and through blockchain, we can actually manage all of the various stages of the development and the ongoing revenue generation of that asset over time. So it's not just that we're representing a cap table on chain through tokenizing an asset and then selling fractionalized shares in that fund over time. It's actually that we're looking at the individual stages of the program, and we're actually representing that through smart contracts and on-chain lifecycle management. So in terms of funds, real estate, private credit, infrastructure, giga projects, precious commodities, these are all really, really popular areas, and particularly interesting where we combine blockchain and the use of tokenization with other technologies. So for example, where you're doing mining of precious minerals and being able to estimate the value of that overall asset even before it's been extracted from the ground, so that we don't actually have to complete the extraction process in order to open up to the investor community. So some fascinating combinations of technologies that we are seeing around AI, around other, GPS and other types of technologies to measure and value the assets which make up the consignment that might be in the fund. So that's on the fund side, and we've actually been doing fund administration for crypto funds for years. We don't necessarily talk about it, but that again is a steadily growing area in terms of the number of funds that we look after today. So again, crypto fund administration is continuing to grow, probably not with the same exponential scale that we're seeing with things like real estate and infrastructure. Now on the currency side, it's very interesting. We've just moved across to tokenizing money market funds. So that's a service that we're launching next month. And the reason that's really, really interesting is because, of course, a lot of the stable coins will be backed by money market funds. I know a lot of you know that already, and that means that we're moving our entire operate model to a much higher velocity 24/7 type operate model. It's obviously a really exciting time, and I know that the guys who are thinking about what they do from a treasury as a service perspective will be thinking about how do they optimize through tokenization of money market funds. It's a really big demand area industry wide. And we've worked really hard to try and get to that sort of follow the sun type subscription redemption model, which I'll probably talk about a bit later on. But it's all about where we're going with the sort of the increased velocity and the movement of collateral and the movement of assets, so we can start to think about how do we use those tokenized assets for other purposes in order to provide incremental yield, because we're not just tokenizing them for the sake of tokenizing them. So on the treasury side, money market funds, and the other area that we're working really hard to take live is tokenization and the ongoing administration of licensed stable coins, and that's another big area of delivery for us at the moment, and very much around that whole 24/7 model where we're constantly measuring the assets backed in custody alongside the number of coins in circulation. So I think there's a lot of development both on the cash side and on the asset side. And as a service provider, we're having to react to that in terms of our operate model and the services we deliver to have a much higher velocity and to be able to provide this whole 24/7 always on type capability, both in the subscription redemption, but also in the ongoing treasury and administration of assets over time. So it's quite a big lift, but a very exciting one for the industry.
Thank you. I guess that comes nicely onto Waqar, where you're looking at new operating models, securities financing, all of these things built into the bank. So where are you seeing the demand in terms of your existing clients, new clients, digital assets?
So the core of the bank, as you know, it's a banking institution. So we provide global corporate and investment banking products and services. And that encompasses our security services business and our markets business and transaction banking business. And then on the other part of our banking institution is our wealth and retail bank as well. So all in all, we're seeing demand across the board, whether it's from the buy side, sell side, people wanting to get access to new asset classes on blockchain. It has been the case for the past few years. So what we've been able to do as a bank is that we've actually taken a very neutral stance in terms of the technologies we implement and the capabilities we bring on board. So that's why we don't subscribe to a particular blockchain. We are totally blockchain agnostic. We are a custodian, at least in my business, and then all the other things that work around it in terms of transfer agency, fund administration, the underlying securities custody, the banking, and then the order processing and making sure that the funds are flowing as they should on a near 24/7 basis is something that has been the demand. It's been quite actively requested. So we've got actual live clients now who are utilizing our capabilities. We are beginning to see 4 critical areas why we're seeing the demand. One is, of course, the promise of liquidity, fractionalization, and access to investors that weren't available readily, right? And given Standard Chartered Bank is one of the very few banks or a GSIB that works with crypto exchanges and has interaction with crypto exchanges as a custodian and as a collateral agent, we are able to provide these assets onto certain rails so that you can actually take your tokenized asset and actually make it useful. Collateral mobility is the first use case we picked. Now we're in the process of working through with some asset managers to figure out how additional yield can be generated on the assets that are being held. So when you look at the universe of our capability, we've had to go on chain for RTA, so we already are with a provider. Then we've had to take the tokenized funds from the tokenization engine onto a public blockchain. Then we've had to create real-time NAV or net asset value that allows us to continuously value the asset near 24/7. And then the next stage that we're seeing right now is the clients are demanding that these assets should be subscribed to and redeemed near 24/7. With that, we are in the process of working with some stablecoin issuers right now, and we hope to have services enabled in the next few weeks. The core of what I'm trying to tell here is that we are totally driven by the clients at the moment. With our business, yes, there is an element of build and they will come. But at this stage, over the past 4 years, and I think in the next 12 to 18 months, nothing in the business that is being developed and deployed is without a client. So if you look at our track record over the past 3-4 years when we've announced things, there's always a client. And now the client demand is growing because on-chain is becoming a reality. Regulations are helping. The regulators are getting on with the program in terms of providing clarity on the utility. Crypto exchanges are becoming a lot more comfortable with traditional assets. So we have a collateral mirroring program with an exchange, and we are beginning to expand the type of assets we will deploy onto the collateral mirroring program. And that tells you that there is a demand coming directly from the clients as well. All in all, this year and next year, there are 3 themes that we're seeing quite important. One is real-time NAV, real-time settlement of funds, then stablecoin integration and digital cash for near instant redemptions and subscriptions, and of course, extended collateral capability that allows the bank to do a lot more with the assets.
Thanks, Waqar. Lewis, over to you. I guess with all the regulatory clarity we've had recently, you may have less work than you did before, or what do you think?
I regret to say there's always work for lawyers. I'm sorry to disappoint the crowd. Regulatory clarity is important, and regulatory clarity has improved greatly due to the demand, due to the factors that the other speakers have noted. But the fact is that capital is global, blockchain systems are global, regulations are local. And so that inevitably creates frictions. Even as we see clarity in a variety of jurisdictions, those clarity developments are not necessarily aligned with each other, and it's difficult to get them to be aligned. So there will always be certain frictions. I think one of the things, from my point of view as a lawyer practicing in this space, is helping people navigate these differing and alternative regulatory systems. What we see here in terms of where the demand is coming from is a combination of things. For the asset management community, and Angie spoke of, there is tremendous value to be added to adapt products and services for the new tokenized world. And I think that's going to be critical, and we're working with a number of folks approaching that. But ultimately, asset management is about aggregating capital from capital holders and deploying it to capital users. And I think we can't lose track of that. I think, for me, the most interesting thing in terms of demand and where our services are going is the intersection of people aggregating capital in the form of crypto assets, non-securities, and deploying those. And a lot of that has moved through vaults and other wholly online systems, and now trying to adapt that for traditional securities and the types of assets that traditional asset managers use. And I think that kind of connection, the synergies and also the frictions, are going to be a really important point. Crypto investors expect certain things natively. For example, they expect almost instant liquidity. That is not something, that's something that works in the crypto world. It's not necessarily something we see with other types of assets. And as some of the speakers noted, being able to address that, including things like real-time NAV, other things are very important. Likewise, we talk about extended collateral usage. Well, crypto lending platforms have instantaneous collateral. In crypto, we have flash loans, right? So we have a lot of things. The asset management sector is adapting to these new demands for more assets. I think it's one of the most exciting things, but from a regulatory and legal point of view, it raises many different issues. We have different precepts around the protections that capital providers need and deserve that, in theory, should help them aggregate more capital and therefore deploy more capital. But that's a balance between those protections and hindrances that don't allow the industry to go forward. So where we see the interest is bringing assets on chain and trying to become as natively crypto or digitally focused as possible.
Brilliant, thanks, Lewis. I guess speakers, there are questions in the comments. I mean, one of them that relates to the demand is around, how do you see, from Elizabeth, how do you see broad adoption of tokenization across capital markets, and where do you see encouragement? So if you're seeing demand pulling your services on chain, are there any areas that you feel that you've had a bit of an uphill struggle in the TradFi space? If any of you want to tackle that question.
I'm happy to chip in on the cash leg. I think you've all touched on the cash leg. I mean, the fact that we're now starting to be able to deliver cash on chain, I think, is a really, really big accelerator for blockchain adoption. We spent 8 years or 7 years talking about use cases and not actually being able to facilitate the final leg of the journey in many ways, having DVP, but with all of the settlement piece off chain. And that was a sort of a halfway house, and it eroded the value of and the power of what you can achieve on chain. I think having the ability to actually deliver cash on chain in the form of a licensed stablecoin or a tokenized deposit, whatever that happens to be, I think, and in a regulatory environment that's conducive to that, which is increasing in number now as we start to see different jurisdictions come online with their stablecoin licensing, I think is going to be one of the biggest single accelerators. And I think if we can drive forward on that basis and deliver high quality stable coins for facilitation of settlement, I think it will make a big difference to a lot of use cases. And I don't know how the people feel, but that's one of the reasons why we've focused really hard on the treasury side and being able to help licensed stablecoin providers to stand up, operate and deliver licensed stablecoins both on chain and cross chain, because I think it will make a big difference to adoption.
I'll add on to that. I totally agree on the settlement side. For me, the largest difference between the community that exists on chain today and the community that sits off chain is custody. Everybody who's on chain has their custody set up, whether it's some form of self custody or they're using a third party arrangement. The folks who are sitting off chain today, the custody is the biggest hurdle. That's the biggest leap for them to move on chain. I think we're quickly moving into a paradigm where there's more custodial options. There's more recognized names in the industry that are getting into the custody side of the game. My hat's off to Waqar and his firm. I believe they've been one of the more progressive in the space in terms of rolling out the services that people are looking for. And I look forward to other peers in the space doing the same thing. I think really at the end of the day, if we can create that seamless transition for folks off chain, whether it's institutional or retail, whereby they're used to one specific setup for what they do for custody, they're used to a specific relationship for what they do for custody, and making that seamless transition within that relationship, within that setup, as much as possible to push them into digital asset custody in a safe and secure, trusted manner with regulations wrapped around it. I think that's going to be the watershed moment.
Thanks,
I'll take 2 seconds on that one. So that's a very important point that Mark's touched on, because when you look at our traditional clients today, the reason they're not, so if you look at the digital assets universe versus what is happening in the traditional world, the traditional custody world, the market is about 250 to 300 trillion in assets, right, globally across all custodians. Now, for the role of the custodian to continue as is, to provide that fiduciary duty, to be able to provide their balance sheet, to be able to provide the risk capability that a bank, a GSIP custodian provides, is even more important with the advent of open blockchains. Yeah. And I guess, I'm representing a bank, and I'll have this view that having a simple wallet infrastructure, right, as a servicer to asset managers, to asset issuers, asset owners, is not enough. Because you will very soon find out that when you touch public blockchains and you start talking about liabilities with your clients, you will need a regulated custodian with the significant balance sheet that they have. By just implementing a wallet infrastructure solution, it is not going to cut it. So we're seeing that demand from the clients quite a lot, and we're servicing the clients. And to some extent, we are a significant sub-custodian as well. And some of the larger global custodians are beginning to utilize us, or are in conversations with us to utilize us in our footprint markets. So that's a very, very important point to differentiate digital assets custody capability versus a custodian's capability, and somebody has to really be very careful, and you have to be very careful when you're picking one or the other in terms of what may suit you, what wouldn't.
Okay, so Waqar, I guess Mark teed you up perfectly for the next question, where we're talking about the transition. So maybe we double down on that. So as a TradFi firm, there's often a lot of asymmetry of understanding or cultural differences between DeFi and TradFi. So understanding why you're concerned about certain risks or why you're looking at liabilities, etc. What is your secret, essentially, Waqar, of transitioning Standard Chartered to then have a mindset of going into DeFi and being comfortable with custody, risk controls, etc.?
Yeah, good question. I mean, again, I stress we're not in DeFi, we're in Web3. So we have to be very careful. We're not saying DeFi. We don't actually integrate with DeFi, at least for now. Maybe in the future when there's well-run DeFi protocols that we're comfortable, we will interact with them. There's a couple of things we've had to work really hard on. One is that we've had to make sure that our infrastructure is acceptable by the teams that manage our risk portfolio and our second line, right? Our second line and our third line had to be extremely comfortable us entering the Web3 world, especially when we manage assets that are in fact hackable. So your Bitcoins, Ethereums of the world, they are the assets that if they are lost, they're lost. So we had to invest in systems and controls. We had to invest in the capability that is built around the balance sheet aspect of our risk capital, right? To be able to understand how much of that we put behind this capability. And then, of course, our insurance providers as well. They had to be comfortable that what we're providing as a bank can stand or withstand the pressures of an external threat or an internal threat. What is also becoming quite clear is that a lot of clients have experimented or gone with wallet solutions because it's very easy to listen to, and I'm going to use a very crude term called crypto bro. You can listen to a crypto bro and say, hey, by the way, I'm going to go plug into a wallet solution provider, and hey, presto, I have the ecosystem. Now I can do TA, FA, I can do, talk to a third party traditional custodian. I can do tokenization and I can actually put it into a wallet, and my system is complete. But what they don't realize is very quickly that when time comes to negotiate on the liabilities, and when something goes wrong, who's going to stand up behind the assets, they pretty quickly find out that the route to go through is a GC or global custodian or a sub-custodian model. That's what's happening at the moment in the market. Whether that lasts for a long period of time, unknown, because the assets that are going on-chain today, they are quite centrally controlled. I mean, if you've got Bitcoin, Ethereum, and those assets that are sitting on the public blockchains that are hackable, then yes, you have got that problem. But assets that are centrally controlled, they have a little bit better fidelity when it comes to protection without having a bank involved. But nevertheless, we're seeing that we've had to invest a lot of time, effort, technology, operating capability into that. And secondly, on top of that, what we have had to do is work with our regulators to convince them that the operating model works for the risk profile of some of the clients we're bringing on. We're bringing on people who've got pension funds attached behind them. We're bringing on people who have their life savings attached to certain entities, right? And this is not a joke. This is generational wealth, which we're going to talk about eventually today. But this is a major transition from TradFi into digital assets world, where we are genuinely no longer playing with NFTs. We're playing with people's lives and their savings, right? So we've had to think quite hard and long which areas we touch, which areas we don't touch, and how we implement and make sure that our clients are comfortable and our regulators are too.
Angie,
a similar question in terms of transitioning Apex into digital. What's that journey been like?
Yeah, so it's quite. I mean, there's a lot of points that Waqar's made that are really interesting, and but in terms of Apex, if you sort of think about where Apex has come from, it's that sort of it's a very sort of, I don't mean to trivialize the whole bread and butter business of TA and fund administration and corporate services. It's a super tanker of service delivery on a global basis that's basically delivering services to 10,000 customers. So we wanted to make sure we didn't throw that away. That's a really big 20 years of building infrastructure on a global basis, delivering that all day, every day to 3.6 trillion, right? So we wanted to say, okay, how can we leverage what we've got already, but build on top of that? And what we recognized is it's moving very quickly, and we didn't necessarily want to sit here and start cutting code from the very beginning. And so our founder went on an acquisition journey. In fact, it was probably about an 8-year journey, to be fair, and it wasn't random at all. It was very, very targeted. And what he did was he acquired a number of different technology pieces that basically would allow us to accelerate that journey into digital. But he acquired them on the basis that we were going to integrate them into our pre-existing service offering. So we've deliberately built effectively a technology layer on top of our pre-existing service offering, so that we could actually leverage all of the underlying services, the sort of the scalability, the robustness, the global presence, if you like, and the existing footprint. And we've actually used components that we've acquired in order to accelerate. So from a technology perspective, it's been a huge lift. I mean, I know a few of those pieces of technology are very well known. Tokeny was very well known. We acquired that last year. We acquired Paxos, which is our main TA platform. 4 years ago, we acquired Unitas as the nominee providing service about 3 years ago. And then we went on to acquire Globocat, which supports primary and secondary in private markets, about 6 months ago. So we've acquired these various pieces, and what it's allowed us to do is, by bolting them together, we've been able to sort of accelerate that journey into the digital space. So we've integrated it all in. And then now what we can do is we're launching a range of service lines that are tokenization specific. Not all of them. Some of them are based on traditional nominee structures as well for fractionalization. But most of the technology we're building sort of strategically going forward on the digital side is all tokenization based and blockchain based. And we're leveraging that tokening and T-Rex infrastructure, which is, again, very well established through the ERC 3643 standard. And we're leveraging that as our base foundation going forward. So big technology lift, which has taken us the best part of sort of 8 years. We've been at it for about 8 years now, and that's starting to bear fruit through not just sort of tokenization of funds, but also some of the newer things that we're doing and the higher velocity service offerings that we're launching now around tokenized money markets and stable coins. But the other area where we've had to lift a lot is in the operate model, and I alluded to that in the previous question, where we've had to lift what is a very traditional sort of 8x5 type structure into a follow the sun 24/7. I think Mark alluded to it as well. It's very much around the sort of the investor experience and being able to facilitate the ability for them to subscribe or redeem in and out of these funds really quickly, for them to be able to make those decisions instantaneously, and also to make sure that we're not in any way penalizing investors by have them, make intraday decisions about coming in and out of these funds. So we've built operate models now that I'd consider to be a lot faster in the way they operate, in a lot more nimble. It allows that whole follow the sun model from a subscription and redemption basis. We will have a settlement capability that follows that, but we're not quite there yet with that. That's sort of the next stage. And I think the biggest area actually where we've probably invested in the last 5 years is actually in education and people. I mean, I don't know how everybody else feels, but actually one of the biggest lifts that we face as an industry is in educating the people that actually embrace and adopt the technology and the services that technology delivers. And we've had to make a big lift in educating people both internally and externally, and I suspect we'll continue to do that for some considerable time, because people still are a little confused between less so. I don't get asked the question quite so often about Bitcoin and blockchain, but I used to a lot when I was at R3 with you, Marcus, right? But so people are more educated, but they've still got quite a long way to go. And as Waqar said, it's not just about spinning up a wallet and thinking you can just tokenize something and you're off to the races. There's a massive amount of compliance and rigor and security and resiliency that goes into delivering those as institutional grade service offerings, which, as you say, your degen bro doesn't really worry about, but our end investors need to be serviced in a way that they don't become exposed to that. So yeah, I'd say technology was our biggest lift. We've made huge investment over the last 8 years, and that's really coming into its own through the launch of a variety of these digital service offerings. I think the operate model has been a significant shift for a lot of people, because there's a lot of us going 24/7 now. It's not just us. I know a lot of the other people in the industry are, and we rely very heavily on them. Like we rely on Zodia and Standard Chartered for example, for digital custody. So we work together in partnership with other providers. And I think actually the education thing, it is getting better, but we've still got a long way to go.
Yeah.
And that's a really important part of the journey, which can't be missed, basically.
Thanks, Angie. I think Mark has spoken publicly about education, and you've also taken a slightly different approach where you call it business as usual, Mark. So we're going to hear your views on that shift for Wellington.
On the education side, yeah, I mean, for us, it's or for me personally, it's constant. So at the start, I'm just going to say, hi, I'm a crypto bro and I'm a DJ. 100%. Like I've done everything out there on chain. I've explored all the different applications, used all sorts of different types of wallets and everything like that. But, to what my peers are saying here, I also wear an institutional hat. And so I understand the difference. One, what I do a lot of is basically going out to clients and partners throughout the industry and melding these ideas together, like traditional finance and Web3 finance, the institutional hat, the DeFi hat, and mostly tokenization and crypto, because there's not enough of an understanding of the intersection between the two, and I try to break down those barriers. When I put my institutional hat on, I'll say, one of the mantras in the industry that people keep throwing around is not your keys, not your coins. Totally agreed with that in 2014 and 2016. But today, if we're talking about, my entire life savings, or if I'm an institution, my entire firm's capital, I want Waqar to be holding my keys, because that's what they specialize in. And I'm not going to take that on myself. It's just not going to happen. We're kind of going back into the days of, banks having vaults and putting your assets in vaults, and you wanted the bank that had the biggest and most secure vault to protect your stuff. On the other hand, I'm educating people that within this Web3 space, like the innovation is absolutely massive. And so, in TradFi, we basically have separate markets for things. It's like, everyone's trying to solve for liquidity, time, price, exposure. And what we do in TradFi is we sort of have like a spot market where you're getting liquidity. And then we have these derivatives markets where you're hedging for price, or, hedging for time. On chain, because of the innovations, because of the ability to embed assets into specific protocols and stuff, we can actually break all of those off, and we can have, one protocol that just focuses on price risk, one protocol that just focuses on time risk, and you get more competition in there, which ends up, lowering the costs. Those are like third order effects that, TradFi hasn't even begun to be able to assess yet. And so like I say, like a lot of my focus is just educating people as much as I possibly can on the intersection of these two, demystifying, telling the difference between, again, to what Angie and Waqar were saying, the difference between Bitcoin and a tokenized money market fund. There's a gulf of difference. One's permissionless, and that's great. That means that it has the ability to penetrate everywhere across the globe, but it also means that it can be stolen. A tokenized money market fund, it does not have the same type of ability to penetrate across the globe. People need to be onboarded in order to be able to touch it, but that means that it's much more difficult, if not impossible, to steal.
Thanks, Mark. And Lewis, so in terms of the transition that Waqar, Angie, and Mark have spoken about, to Jack J's question in the comments, do you think regulators are keeping pace with this? How, as a law firm, you're dealing with that cultural shift, and then also managing the regulators and the legal side as well?
Sure, I'll touch on the regulators, and they're kind of like the fat guy huffing and puffing. They're doing their best, in the race. But it's challenging, and it's made more challenging by the fact that there's such a diversity of perspectives, views, jurisdictions, and kind of ways of thinking. I want to really double down on something that's been a theme just across the last comments. And Waqar, you really kind of kicked it off, Web3 versus, full-on crypto, degen folks versus crypto folks. There's really, in my mind, in my experience working with people on both sides of TradFi and the DeFi side, there is a blending across these things, right? There's no more bright lines. And I think this is part of what the asset management sector needs to adapt to. It's changing. If I can draw a quick analogy, if we think about sort of food, all of us are capable of cooking, I hope, and we can cook for ourselves, but we like to go to restaurants. Restaurants are very popular. Why? Because some people do it better than others, right? So it's similar with asset management. The crypto folks talk often about self-sovereignty, the ability to manage not your keys, not your coins, and DIY your asset management. And for some people, cooking at home works. And for some people, they're amazing chefs and invite people over and do that. But for many people, they want the services of people who are truly professional. There's this added regulatory layer when we talk about people's capital, but at the end of the day, what we're seeing is a blurring. So in the same way that you can think about, it's not just a binary choice of, well, I'll cook it at home or I'll go out for a meal, I'll manage my own assets or I'll put them in trust with an asset manager, but all sorts of things in between. For example, there's delivery services that ship you all the ingredients and then you just assemble them at home and make them. There's a blending of these business models. And I think what's so exciting about the asset management sector right now, from a regulatory, legal, and transactional point of view, is people are experimenting with many different models. Some of them will fail, some of them have failed, but some of them fail and keep going and developing. And I think regulators need to understand that this period of experimentation is critically important. But like the proverbial changing the jet engine while the plane is in flight, we have to ensure, as Waqar said, these are people's pension funds. These are huge, important, life-changing decisions. We can't just willy-nilly change it. And regulators, I think, are doing their best to keep up with that while allowing these new business models to thrive. One of the most interesting things that I see, just as one example, is yield that can be paid not just daily, but perhaps hourly, by block, as capital is allocated in a particular sector, it can earn yield on a block-by-block basis. These are game-changing technologies, and I think we very much want that experimentation. Regulators don't have a box to put that in, and we're going to have to help them as lawyers and business folks and other people understand this and implement it into regulations that are balanced protection of investors and encouragement of this kind of innovation.
Thanks, Lewis. So the next area we wanted to discuss was around the opportunities. So you've touched on it in a lot of your comments already, but I mean, in terms of the most interesting to the asset managers themselves, so in terms of bringing products on chain so that we can access yield as an on-chain investor, Waqar, what are you kind of seeing as the most interesting opportunity in the asset management industry from your perspective?
Oh, you're on mute.
Apologies. Can you hear me now?
Yeah, perfect.
Yeah, so we're beginning to see a lot of asset managers are beginning to show a lot of interest geared towards attracting the eyeballs of those that have veered into crypto, and those who have become very used to near instant 24/7 accessibility, where people can just buy, sell really small fractions of a particular asset, and then when they hold it, they get some yield on it as well, right? So there's a lot of emphasis on that. Yes, there's also the aspect of immovable assets, so those assets that are sitting in books that never get valued. So there's a desire by some of these to be valued, put it onto the market, and fractionalized and released. There's a challenge with that, though, that although we have mildly successfully done the primary subscriptions and redemptions, as well as allowing clients to hold them near 24/7 and settle them, with a degree of uncertainty around T0, T+1, and T+2 in certain markets, the secondary market for these assets are still not there, right? We're still operating at the primary subscription redemption level, and we would love to see more of that. And that's where some of the asset management clients are beginning to ask questions, saying, well, it's good to see, platforms listing these assets and for us to facilitate primary subscription redemptions, but when and how are we going to realize a secondary market? And that's where that is the beauty of blockchain, and that's where fractionalization really helps. They are asking questions, and we are looking at solutions at the moment, but nobody has, the silver bullet to fixing the secondary market liquidity issue in tokenized assets in general, not just tokenized funds. But watch this space. Over the next 2 years, we are investing a lot of time and effort into helping our clients get through that stage as well.
Okay. And Angie, is this more of a fundamental shift for asset managers, or is this more of a distribution channel? What are you kind of seeing as the main opportunity for them?
I think that you have to look at where your consumer base is going. So if you look at I'm sorry to quote the number, but I have to, just every day I wake up thinking about the 124 trillion. I know Citi put it in a blog. We've got 124 trillion of private wealth being passed down through the generations over the next 2 decades, probably over the next 15 years. And I'm sure we're all sitting here thinking, what's the best way of accommodating that from the expectation of the investor of the future versus the expectation of the investor of the past? They're very different things. And I only have to look at my own son sitting there day trading whilst at university in his 4th year with a bunch of his friends on a Sunday afternoon and making investment decisions instantaneously and having 2 day trading accounts and thinking nothing of shifting from one diverse asset class to another. So I think you're facing a completely different investor community and a set of expectations around that investor community that's very different to what we experience today. So there are a few things that I think are going to make a difference. I think the use of blockchain, decentralized technologies, whether that's private chains or permission chains, I think mainly in institutional worlds it'd be permission chains with compliance embedded in them, because it has to be, because we need to know who's investing and who we're selling to. I think so the whole decentralized infrastructure space, I think, will dramatically change the accessibility from the issuer to the investor, and that's a given, and we're already starting to make good headway in that with things like the project that we've been doing with LSEG in bringing those communities much closer together. I think the primary and secondary, to Waqar's point, I think the primary and secondary markets will advance significantly. And in fact, was one of the areas that we're working really hard on. And one of the reasons why we invested in Globacap was to really provide a single seamless experience for both primary and secondary investment, so that they're not sort of stepping off one platform and one technology to go back to an existing legacy platform to do secondary market trading through some sort of, bid offer board or some things. I know that obviously the market models are very different to electronically driven markets, but still we can be much more sophisticated than we are today on digital assets that are represented on chain. So I think Waqar's right. We'll see quite a lot of advancement in the secondary market piece, which, as you can imagine, for certain asset types, particularly because they're very liquid and esoteric, will make a very big difference. And I think the other area where we'll see significant changes in the diversity of asset class coverage. So if you actually look at the range of assets that people are interested in, it's much more diverse than it has been in the last sort of 10, 20, 50 years. People have tended in capital markets to be limited to a relatively small but very safe range of regulated instruments. And I think what we're seeing now is, particularly with the investors of the future, is this appetite to have a much greater diversity of assets that have a very different type of risk profile, but have greater rewards as well. So they think, to be honest, certainly my son's not interested in yields of 5%. He might be interested in yields of 15%, but anything in single figures doesn't even hit his radar, basically. So they have to diversify their investment strategies in order to get a much better yield, because they're not interested in the stuff that we were all very happy with 10 or 15 years ago. And I think we've got to be able to respond to that by being able to access a much more diverse range of instruments and funds and collectors of instruments, which we're seeing through the tokenization of private markets. So I think there's a lot of different changes, but if you actually look to Mark's point and to Waqar's point, there's no point in building this technology if you're not actually addressing the requirements of the investors, and the investors of the future are very, very different to the investors that we have today, and we've got to be moving towards that in order to accommodate them. Thanks,
Angie. Mark and Lewis, your comments on that?
No, just quickly pick up on something Angie said about the changing investor base. I just came back yesterday from Florida from a major family office conference where I was speaking, and the interest among generational wealth and family offices in this space is just off the charts. It was incredibly well attended, a lot of enthusiasm and energy, and I think you're absolutely right, Angie, to say that the asset management industry just has to adapt to those changes, and we're seeing it in our practice, and I think that's what's coming next.
I'll just round us off by saying this is global financial freedom and empowerment technology. This is about bringing financial services to the parts of the world that are completely underserved. There are entire countries where we cannot deploy a commingled vehicle like a UCITS fund or a mutual fund because the cost of operating that vehicle relative to the amount of assets you could gather within that country is just infeasible. Using this technology, we can go to underserved parts of the world and we can bring financial services to people who desperately need them. We can lift them up and give them a better life. At its core, that is the foundation and ethos of everything that the crypto Web3 blockchain community has been about and always will be about. And I'm so excited to be a part of this revolution.
I think that's a great way to round it off, Mark. Thank you for that. So we're out of time, but thank you speakers for your time, your comments, really, really insightful. And we are live next month, so we'll be doing these monthly, so please look out for the invite. We'll be digging deeper into the portfolio management and what wealth on chain looks like, which will be super interesting. Thank you all for joining, and please reach out if you're working on this space. We're deep into asset management on chain, and we'd love to hear from you. So thank you all, and have a great day.
Thank you, everyone.
Thank you.
Take care. Bye.
Thanks.